Hello, my name is David Miller, and I'm the manager of Nexus Global Solutions Portfolio and Nexus Global Dynamic, along with my colleague Carl Williamson. I'm speaking to you in early November. Well, after the trials and tribulations of September, October was the best month of the year, and both portfolios responded well. Dynamic was up by just on 3%, Solutions by over 2%, bringing the year-to-date returns to around 12% for the all-equity dynamic portfolio, and just over half that for the diversified solutions portfolio. So those are both very good real returns over the rate of inflation. And just a note, following on from positive returns during the pandemic-affected year that we went through in 2020. I think the approach we've got has proved that it works in a whole range of different and unexpected environments. So, what changed in October? Well, I finished off last month by saying that I hoped that the company results season would settle nerves, and that actually proved to be the case. Year on year, from this time last year, companies have on average increased their earnings by 36%, and after all, that's what we invest in. The other factor, which continues to be helpful, is that the global economy is growing. A bit slower now than earlier in the year, but not surprising to see that moderation given the rapidity of the bounce from the recession of last year. This is good news. This is what we're investing in. All of the other factors that headline writers and commentators like to obsess about, inflation out of control, higher interest rates to come, COVID, global political risk, supply chain problems, you name it. These things are all factors when it comes to making an investment decision, but they don't dominate in the way that might be expected. As I said, it's all to do with finding growth and attaching oneself to that at the right price, and that's what we do. So back to the detail of the portfolio, not the generalities. Equities was the place to be. That's why Dynamic did better than Solutions. Growth was coming through very rapidly. The best performers, a whole range of companies based in different parts of the world. Top of the pile was Tesla, a technology company in the US, Nvidia, Union Pacific, hardly a high-tech company. Railroads in America are making money. And in Sweden, an engineering company called Epiroc. As you can see, it's broadly based and not just focused on one particular sector or one particular country. On the solutions portfolio, where we have other investments, not just equities, a mixed bag of returns. Perhaps surprisingly, given that interest rates are likely to be on a rising trend over the rest of this year and into next. Fixed interest stocks produced a good return, and the longer dated stocks did better, not only than those due to be redeemed in the near future, but also index linked. Hedge funds, private equity, infrastructure made modest contributions. We can't have everything firing on all cylinders all the time. That's where diversification has its advantages, but sometimes in the short term its disadvantages. With solutions, what we're trying to do is smooth out the ride, and that has proved to be the case over this last couple of years. So to the future, which is what we now have to invest in. We've got through 10 months of this year in good shape. We are now faced with any number of challenges, but it's always the case that they are out there. But as I said, the background of growth, economic growth, and good companies producing good profits is a great place to start from. I can't say that it's going to be all plain sailing, but we have positioned both portfolios for further growth into the end of this year and into next, because we think that's the right place to be. I hope that you found these comments useful, and I look forward to reporting to you again in a month's time, which will be pretty close to Christmas. So that'll be another reason to celebrate. But for the moment, let's just focus on the investment returns. Thank you.